Welcome to the BioPharma Business Intelligence Unit, where symbolic integrity meets strategic clarity. At BBIU, we go beyond the headlines to decode the structural forces behind global biopharma, AI, and economic realignment. If you value precision, verification, and symbolic depth, this channel is for you. Subscribe now to access our weekly briefings, dossiers, and intelligence reports, and consider joining our institutional tier to unlock early warning systems, custom metrics, and exclusive strategic insight. You're not just listening, you're entering the future of epistemic intelligence. www.biopharmabusinessintelligenceunit.com.
Building tax capacity for growth and development. IMF's 15% threshold and the global fiscal divide. Executive summary. The IMF's recent departmental paper places taxation capacity at the heart of state resilience and sustainable development. Its central message is clear. A tax-to-GDP ratio of at least 15% is the critical threshold for countries to escape the low-growth trap and achieve institutional strengthening. Currently, 71 developing economies remain below this 15% benchmark, with fragile and resource-dependent states disproportionately represented. The IMF identifies an average tax gap of roughly 5% of GDP in low-income countries. Revenue that could be mobilized through policy reform, improved administration, and digitalization. The report highlights not only the quantitative shortfall, but also the qualitative dimensions of fiscal systems. Broadening tax bases, rationalizing expenditures, modernizing VAT, leveraging property and excise taxes, and ensuring compliance through governance and digital infrastructure. Importantly, the paper integrates this fiscal target with the Seville Commitment 2025, which enshrines the 15% ratio as a global political and developmental benchmark. BBIU opinion. The IMF's 15% rule as oversimplification. The IMF's 2025 departmental paper presents the 15% tax-to-GDP ratio as a universal threshold for economic growth and state legitimacy. While the logic is seductive in its simplicity, higher taxation leads to higher capacity and therefore higher growth, our structural analysis identifies this as a case of functional oversimplification. 1. Correlation versus causation. Countries above 15% tax to GDP often display stronger growth, but this does not prove taxation caused the growth. In many cases, growth enabled higher taxation, not the reverse. This inversion is particularly visible in Asia, where industrialization preceded fiscal expansion. 2. The quality of spending matters more than the quantity of taxation. The IMF model assumes additional revenue translates into productive public investment. Yet, Brazil collects more than 30% of GDP in taxes with stagnant growth, while Singapore sustained decades of expansion with a leaner, business-friendly fiscal framework. The composition of spending, education, infrastructure, governance determines growth, not the absolute level of taxation. Nub 3. Regional heterogeneity breaks the model Nordics Europe. The 15% threshold is long surpassed, but the model works because of trust, redistributive spending, and institutional quality. Latin America, high taxation coexists with low growth due to inefficiency, rent-seeking, and corruption. Africa, the challenge is not tax rates, but enforcement, informality, and dependence on resource rents. Asia, divergent paths. Japan and Korea mirror the European redistributive model, while Singapore and China rely on competitiveness and selective taxation. 4. The political function of the 15% rule. By enshrining a single figure, the IMF and the UN's Seville Commitment convert a technical correlation into a global standard of legitimacy. States below 15% are automatically categorized as fragile, creating a new metric for conditionality in aid, debt negotiations, and multilateral financing. The rule thus operates less as an economic truth and more as a classification instrument of geopolitical governance. Number 5. Hidden incentives and systemic dynamics. In advanced economies, personal income taxes, PIT, bear the brunt of fiscal pressure, often exceeding 45-55% at the top marginal rates, while corporate income taxes, CIT, remain moderate, 20-25%. Dividend taxation varies widely. Nordic countries impose harsh double layers, while Singapore exempts dividends entirely. This design implicitly incentivizes entrepreneurship and corporate structuring, since channeling income through firms reduces effective taxation. The IMF paper overlooks this asymmetry, presenting taxation as neutral when in fact it reshapes behavior. Final assessment. The IMF's framework succeeds in highlighting taxation as a cornerstone of state capacity, but it fails as a universal growth model. By compressing complexity into a single number, 15%, it risks misleading policymakers and legitimizing external conditionality without addressing structural differences. BBIU integrity warning: the 15% rule is not a law of economics but a narrative device. For countries under the threshold, the challenge is not simply to raise taxes, but to build institutions, improve spending quality, and design fiscal systems aligned with their productive structure and social contract. Annex 1: Equality, Polarization, and the State beyond the IMF's 15% rule. Annex 2: The pattern of rulers when 15% is not enough. Conclusion: beyond numbers, the human cost of fiscal evasion. You've reached the end of the open section of this BBIU content. The complete analysis, with full data, structural frameworks, and extended annexes, is available exclusively to our subscribers. At BBIU, we believe the real value lies beyond headlines, in the depth of structural intelligence that helps leaders and organizations see further. If you want access to the complete archive and future reports, join us at BBIU and take part in the next level of analysis.